Welcome, everyone, to Daniel Krug and Associates Wealth Management Review for October 8th, 2020. Today's presentation is entitled Election Tax Planning, and this is a pre-recorded event, and I will touch on that in just 1 second here. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel Krug, CEO and Senior Wealth Manager, will be joining me in a little bit to help out with the presentation. I'm just going to remind you that this presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. If you have any questions, please just give us a call in the office and we will help you out with that. We're looking at 30 to 40 minutes today of this presentation. There's a lot of data that's going to be covered, so we hope you learn a lot. Again, this session is being pre-recorded because we are actually in the middle of moving back into the office, and a lot is going on in the office this week, so getting ready for a reopening. Again, everyone is muted. There is no chat room this week only, so just remember that. And we want to thank CNR and the Capital Group for their contributions to the data that we're presenting today. Let's move on. A reminder that wealth management basically encompasses many things to many different people, but what it means to us is you have to have a foundation of a solid investment strategy, and that's that big overriding bar on top here. But how we differentiate ourselves from other firms is we really get into the advanced planning, and we found that's really where you can maximize your performance and your net worth over time. And those strategies are things like wealth enhancement, and you can see the subcategories there, wealth transfer strategies, wealth protection strategies, and about a third of our clients are charitably inclined, so there's many things we can do from a charitable aspect to maximize your wealth and minimize your taxes. So today's agenda, we're going to cover major developments that have taken place this past week, an update on COVID-19, and then we're going to get into the impact of tax policy on income and investing and some of the opportunities and strategies that you can take advantage of as things change. So let's start with the major developments in the past week. President Trump and First Lady Melania Trump have tested positive. I'm going to hop off here so that you can see the full screen. So again, President Trump has COVID. He tested positive for it. The latest is he was released from the doctors and is back in the White House, but that's something we're going to keep an eye on. The GOP is moving ahead on the Barrett confirmation for the Supreme Court, and Democrats are trying to come up with ways to stall that process. We'll see how this plays out. Unemployment dropped again this week to 7.9%, so we're under 8%. So that is moving in the right direction. COVID-19 death rate also has dropped. It's dropped below 1,000 to 900 on the 7-day moving average. So that's pretty significant considering where we were just about 6 months ago. And the Michigan Supreme Court ruled on Friday that Governor Whitmer had no authority to issue or renew the executive orders relating to COVID beyond April 30th. And again, there's other changes that have come subsequent to that. And we're not going to be able to get into all of it, but I'm sure that's going to be something that's going to continue this week to play out and how we have to respond to the orders coming out of the government. So I'm going to kick us off with a COVID-19 update. Basically, we're going to start with Michigan first, since that's our home state. And as you can see in this slide, Michigan is divided into 8 regions. And it's basically the colors represent the risk level. So from light to dark, low risk to high risk. And you can see that where the Detroit area used to be the hot spot, that actually is moving away, and that area is flattening and improving. The Traverse City area is improving, but central lower peninsula around Lansing actually has an increase in the spread, and as does the upper peninsula. So what it's going to take to actually reopen we're not clear on yet. Again, there's a lot of wrangling going on between the government branches right now, and we'll see how this all plays out. When we're going to look at two things in the state of Michigan. First is the number of cases, and then the second is the death rate. So the first slide here is based off of the number of new cases, and you can see that new cases have gone down, but kind of leveled off after the end of summer. And we see a slight little bit of a increase in September, but then it's starting to drop off again going into October. We're testing over 30,000 people a day for COVID. So you're going to get a higher case reading just from the number of tests that are going on. When we look at the number of deaths, though, however, it's very much different. We've had a 96% drop in the average number of deaths, April 12th through September 29th. So even though the cases, because the number of tests are going up or at least staying at a higher level, we obviously have figured out different ways to manage through this and keep the death rate continuing to slightly go down. Let's take a broader view and look at the U.S. and the world. And what you're going to see here is the total United States. Again, this is cases that were reported to the CDC on a 7-day moving average. And I like to just kind of follow the red trend line here and see that back in April, we kind of started to come down, but then going into the summer, the United States kind of spiked. If you remember, a lot of that was in the South and Southwest where it wasn't originally at the beginning of the pandemic. It came back down and slightly went up a little bit. Again, a lot of testing is going on, and that's what's creating the number of cases to basically increase. But when we look at this trend line, it seems like overall it's moving in a positive or flattening direction. Let's look at the death rate relationship to that now. And what you can see is that the death rate is gradually declining over time right through last week. So we're on the right path as far as how to deal with the virus and to mitigate its impact, the deaths that are a result of it. And we've learned a lot, since we've been in this. So I think there's been a lot of improvements in the way doctors and hospitals and everybody has been taking care of things, the social distancing, everything's played into keeping this relatively low compared to where we were at. When we look at the overall cases around the world, you can actually see that going into the summer, the cases were going up. And it's hard to see the trend line behind that 7-day moving average of 287,847, but it appears to be flattening out there as far as the number of new cases. So that could be a good sign. And when we look at the daily deaths worldwide, that also, the trend line, which is the light colored line floating through the bars, seems to be moving in the right direction. We are continuing to go down in the death rate due to COVID. Okay, so that wraps up COVID, and I'm going to pop back on here, and I'm going to ask Dan to join us and take us into the election and the potential tax ramifications of what's coming with this election coming up in 2020. So Dan, you want to take over?
All right, very good. Thank you very much, Rocky. I appreciate that. And it's good to hear that the numbers are still coming down. All right, I'm going to look at things from a different angle here. I'm going to take a look at election 2020 and the policy impact on income and investing. Because at the end of the day, regardless of whether Trump gets in or Biden gets in, we want to have a plan. We want to have a plan from an advanced planning standpoint and an investing standpoint. So when we're looking at the slides coming up here, we're going to go through a lot of data. At the end of the day, we know that you need information. We don't exactly know how the election is going to play out, but what we do know is that once it does and we have a deciding factor and we know who's going to get into the White House or stay in the White House, we will then be able to execute plans accordingly. We're going to get you the information that you need. give you as much information so you can make some logical decisions moving forward, and ultimately so you can have victories in investing and your planning process. We want you to get across the goal line, and we're going to really bring every strategy necessary to allow you to succeed. Let's go forth. We're going to look at the taxes from an individual standpoint and from a corporate standpoint and how they relate to you. And we'll break it down like this. When you think about it, the tax plan proposals, November 3rd is right around the corner here. And the general election is actually less than 30 days away. So we really do need to understand how the ballots are looking and how the proposals are looking for each one of the parties. So one of the main issues here is going to be the Tax Cut and Jobs Act. Is that going to remain under President Trump? Or if Biden gets in, is it going to be repealed? And that's on the ballot right now. Many provisions of the Tax Cut and Jobs Act are actually scheduled to sunset in 2025. So it was already on the books to expire. Now, will it expire earlier? And based on the different proposals with the parties, it looks like it might very well. So let's take a look at the candidates' views. The Democrat presidential nominee Biden has taken the position that many of the provisions within the TCJA actually favor the affluent. And because of that, there's a perceived imbalance. Now, if you look at it from the Republican side, President Trump believes that the Tax Cut Job Act really has spurred economic growth. And if you leave it in place as we get through COVID, it's going to do the same thing again, spur economic growth. So we have a good understanding of what Trump is going to do because we've had 3.5 years, almost 4 years of understanding what his economic policies are. So we're going to focus more on Biden's plan because that's the one that is new and people need to really understand to be able to make a good decision. So let's start out with ordinary income. We do know that from the Democrat side that there would be a raise in the top bracket to 39.6%. For any kind of taxable income that is greater than $400,000. If you switch over to the Republican side, we all know we're currently at a 37% top bracket, and that's for over $518,000. So a bit of a difference there. Now, let's take a look at the bracket thresholds for both parties, the Republicans and the Democrats here. You can see that some of them stay the same, the 10% and the 35%, but the other brackets are going to increase. Now, what we do not know is what the thresholds will be under the Democratic proposal. There's really nothing out there that tells us that. But we do know the tax brackets are going to go up. Now, when you look at the center column there, this is the tax increase, and this is the percentage of increase over the previous bracket. So if you look at, let's go right down the middle there. On the Republican side, you got a 22% tax bracket. On the Democrat side, you got a 25%. And that is a 13.6% increase over what we're used to right now and have been used to over the last 3 years. And likewise, the rest are modified except for your 10% bracket and the 35% bracket. Those are the two where the percentage of increase is just not there. Now, again, what we don't know is what is the income threshold associated with the Democratic's proposal. And that we'll just kind of keep an eye on to see where it goes. But we do believe, based on the proposal, that the tax rates and the taxes will go up accordingly. So let's look at the impact that this has on your individual tax returns. what we've done is we've set up really several proposals here, some pro formas, if you will. And what it shows is taxable income on the right side and different types of taxable income, wages, interest, dividends, capital gains, things like that. Then you've got the current tax law and income associated with it. And then you've got the Biden proposal and income associated with it. As you can see, when it comes to the income, all that stays the same because we're trying to look at this from an income standpoint, apples to apples. Now, where does it change? It starts changing at the effective tax rate. So when you're looking at the current income tax rates and then against the Biden, the effective tax rate for the current is at 10.3%. That's what you would anticipate based on the income that's showing right now. If you look on the Biden side, you would see that the effective rate would be more like 12.4%. And strictly based on the brackets that are shown today, that's about a 20% increase in taxes paid over time. So it will make a difference. And what we're looking at for this one here is people who are making about $65,000 married filing joint. So again, the difference here is about 20% additional taxes under the proposed plan. Let's step forward. Now let's look at an individual who's got, a married couple filing joint again with income of $150,000. Now for this one, the effective tax rate under the current plan is going to be around 13.9%. You look under the Biden proposal and the taxes on that, the effective tax rate ends up at around 18.5%. And as you can see, if you're in this income group, you're getting hit a little bit harder than you did for an individual that has a $65,000 income. And I suppose we would expect that. So in this scenario, we got about a 33% increase in the tax that is paid on the income we earned. Now, in both of these cases, we've got retirees. So I'm sure you probably noticed that there was no salary and wages. So this is someone who is retired. They don't have kids. They're not taking any kind of deductions that are relative to tax credits and things like that. So that doesn't apply here. But let's move on to the next one. The next one is actually a high income earner. We've got, again, two individuals married filing joint. You can see that they've got a high income salary. They've got interest, capital gains. They even actually are getting a pension because perhaps they left one job and were able to start that pension and started a new job. Not uncommon these days, right? In this case, the total income is about $477,000. They're taking about $47,000 in deductions, giving them taxable income of $430,000. So you can see under the current plan, the effective tax rate is at 20.3%. You look under the proposed plan with Biden, and it goes up to 23.6%. So now you can also see that this income range for this specific illustration has about a 15.9% increase in the amount of taxes they had to pay. So it is kind of significant when you're looking at your income. Why do we bring this up? Well, because strategies matter. And if you don't have a strategy to combat this, you're going to end up paying more taxes regardless of whether it's under the current plan or under Biden's plan. Although under Biden's plan, arguably it's going to be higher. But you have to have a plan. So let's go a step further and let's take a look at a client who has completed our comprehensive tax mitigation strategy. So they started their strategy 5 years ago, and now they've actually gone all the way through. We're going into an election year. They're wondering, okay, how is this going to look when you're thinking about the current tax laws? And if Biden gets in, how is it going to look after he's in? So let's kind of move forward and take a look at that. So how would this impact the individual's tax returns? Well, all right, in this scenario, we've got income of $215,000. They're retired, married, filing joint. Now, they have no wages because they are retired, so we're really only seeing interest income, dividends, capital gains. You've got your IRA distribution from their minimum distribution, so clearly they're over 70. So they've got their minimum distribution there. They don't have any rental income, and their overall adjusted gross income is $24,000 under the current plan and under Biden's plan. Now, assuming the deductions haven't changed, because we're not really clear on how the deductions are going to work under the Biden plan. So we're making an assumption that the deductions will stay the same at this point. You can see that they're showing no income. And then you might be scratching your head saying, wait a minute, they have $215,000 worth of income. Why are we only showing $24,000? Well, it's all because of the tax planning that was done years in advance. So let's take a look at it. Since $191,000 that they have in income actually came from either a Roth IRA, tax-free, or an overfunded life policy, again, tax-free, they actually don't have to report that income on their tax return. So that income is tax-free. Now, why is it tax-free? Because they paid their taxes many years ago on this money, converted it over to tax-free, and now it's paying off to them. So as you can see, even though this individual has $215,000 worth of income that they're living on, so they're making a nice retirement living, you can see they ultimately aren't paying any taxes this given year. And as long as they follow this strategy, they will not be paying taxes the rest of their life based on Biden's tax plan or the Curtin strategy. And I'm here to tell you, we have clients that are in this category right now. They paid their dues. They've got nothing but tax-free money or possibly tax-favored money. And in this case, they're ultimately, with their deduction, able to eliminate anything that was taxed and end up with a zero effective tax rate and a big zero on the amount that they owed Uncle Sam. So this is phenomenal, but this is tax planning, and it doesn't come without a little work. There's a lot of work that goes along with this from the client side and from our side to make sure that our clients get what they need to get. And that is a proper plan, properly executed, and ultimately bringing in the bacon down the road without any kind of taxes associated with it. So that kind of gives you an example about how these current tax laws set up properly with tax mitigation could very well end up being a non-game changer for you, because either way you would have paid no taxes. So let's talk a little bit about capital gains. Now, the Democratic proposal would eliminate the favorable 20% tax rate. Now, keep in mind that currently the taxes on capital gain could be 0, 10, 15, or 20%, depending on your income. Now, what would the Democratic proposal do? It would actually bring the capital gains to ordinary income rates. Now, this is where we're not really clear. We've kind of searched for the data, but we can't seem to find it. And that is capital gains rate only for income earners with 39.6% tax rates and higher, or, and that would really preclude anybody that has income of less than $1 million, or does the ordinary income tax rate apply to every one of the tax brackets? That's something that we're searching for. We're trying to get the answer. Once we do, we will bring that to you. But at this point, we're really not sure how that's going to play out. Now, you compare it to the Republican program, they're looking at maintaining the tax proposal as it is. And what does that look like? Again, the current tax law is 20% or up to 20%, depending on your income. And then if you're over $441,500 in income, you would also get hit with a Medicare surtax. So a total of 23.8% is where we stand today. How does that look? Well, again, these are the proposed plans. The capital gains on the Democrat side, we're not really sure how it's going to apply to any income under $1 million, but we do know over that, you're looking at 39.6 plus the Medicare surtax. If you look over to the current and proposed plan, you can see a marked difference in the way the capital gains are going to be taxed. And for anybody who has a lot of non-qualified money in the markets, this is a game changer for you. So it's important when it comes to whether this thing goes through or not, how we're going to respond to it. Now, let's also talk about stepped up basis, because that goes into the same kind of arena here. What do I mean by that? Well, let's assume I have $1 million in a brokerage account, non-qualified money, and I've seen it go up $200,000. So now I got $1.2 million in that account. Well, if I died today, my kids are going to get the stepped up basis, so they're not going to pay any tax because the basis is going to go up to that $1.2 million. If we look at the Democrats' proposal, they would eliminate the stepped up basis, so my kids would then have to pay tax on that $200,000. And again, we're not clear on how that capital gains is going to work, but we do know that based on the proposal, there is going to be a tax on that. Whereas today, with the Republicans' proposal and the way it's currently structured, that wouldn't change. We would still get the stepped up basis. This is a big deal for many people who have non-qualified accounts, properties, houses. I mean, there's a lot that goes into this that could take away from an estate from a tax standpoint. Now, let's look at estate taxes. So the estate taxes, everybody knows the exemption skyrocketed here for each individual. So most people weren't really worried about estate taxes. But what Biden's proposal is going to do is bring it back down to the TCJA levels. Now, no one's really clear on what that's going to look like. There's been talk anywhere between $1 million and $5.3 million. So we'd have to kind of wait and see how that plays out. But at the end of the day, it's going to make a difference in many people's overall circle of wealth when it comes to transitioning the estate. Then you look at the gift tax. The gift tax is also going to be lowered, and then the transfer tax would move from 40% up to 45% with the Biden new proposal plan. So an additional 5% would be lost on the estate. So additional planning is going to be critical should the Biden plan actually come to fruition. And we'll take a look at some of that. Let's also look at the corporate tax and its effect on corporations and employees, because we've got to look at everything holistically when it comes to the tax laws. And when they talk about how the corporate taxes are too low based on the current plan or Biden plan that he has, you got to see what the proposals are going to do are going to affect not only corporations but employees. Let's take a look at how that works out. So the corporate tax rates from the Democrat side is looking at moving it from 21%, which is where it is currently, to 28% on income earned in the company, the profits. If we take a look at the Republican plan, they would like to keep it at that 21%. Now, again, if you're looking at the corporate rates, you've got to look at not only big corporations, because the corporate rate affects all corporations, large and small. So let's take a look at the small business owner, because we know the small business owner accounts for about 50% of the revenues in the business and the GDP when it comes to the corporations here. So looking at a small business owner, if they moved from 21% to a 28% tax rate on their profits, well, this is kind of what it looks like. The $200,000 profit in this example would have an additional 7% tax on it. So this business owner would end up paying an additional $14,000. Now, how does that play out, though, when you're talking about adding that tax to the proposed Social Security payroll tax increase that's coming down the road here, if this plan goes through? So the Democrats' proposal on the Social Security payroll tax is to increase it an additional 12.4%. Well, that breaks down into two different groups. 6.2 for the individual employee to pay, and 6.2% for the employers. So that's double what both groups are paying right now. The proposed plan is saying that if you have income greater than $400,000 as an employee, then you will end up paying 6.2% above that $400,000. Now let me back up a little bit here. Currently, if you have wages up to $137,701, you get charged a 6.2% tax. It comes right out of your paycheck before you get it. What would happen if you earn more than $400,000 is between the $137,701 and $400, you don't pay any additional. But if your income is, let's say, $450,000, then you would pay the tax on the additional $50,000 over the $400,000 threshold. So you end up paying a little bit more if you're making more. So again, I want to repeat, in this scenario, they're talking about adding an additional 12.4% on top of the current 12.4% that's being paid today. If you look at the Republicans, they're talking about maintaining what we have already. And again, that's a Social Security payroll tax for individuals, the employees at 6.2, and the employers at 6.2, all the way up to 137.7 on your income. So there's a major change right there. Think about it. If I'm an employee, they're already taking 6.2 out. If, in fact, the proposal goes through, now they're going to take 12.4 out. That kind of hurts. Not only the business, but the employee. So look at this. I'm going to show you kind of three AGI scenarios. If I made $65,000 for a company, that was my wage, I would now be taxed at 12.4%. Well, that's about $8,000 every year. Well, what if I made $150,000? Well, now I'm going to pay $17,000 a year in Social Security benefits tax. What if I made the $477,000? So it's above the $400,000. Well, 12.4% all the way up to $137,700, and then another 12% on anything over the $400,000. So in that case, I would be paying $26,622. And I have to stress this. This is not all your taxes. This is strictly your Social Security payroll tax. Now, I also want to mention that if you're retired, you're not paying this because you don't have wages. This is only wage earners that would be taxed this way. Well, okay, so now let's look at it from the corporate side. How are the corporations going to be affected by this tax? Well, let's take the average small business owner again, and let's say they have a payroll of $24,000 a month. That gives them a $300,000 payroll. All right. On that payroll, they aren't going to pay 6.2% like they have been doing. They're going to end up paying an additional 6.2%, which gives them an additional tax of $18,600. Well, okay, that comes right out of the profits, right? Well, let's go another level. What about a business owner that has a $100,000 monthly payroll? Well, I know several business owners that do this. Well, that 100,000 times 12 months, you've got $1.2 million in payroll. In other words, keeping people employed. Well, at an additional 6.2, we now are going to pay about $74,000 in taxes. Well, that first small business owner that had the lower number, 300,000, that could be the difference between employees getting raises, new benefits, or not. In this scenario, what we're looking at with 74,000, that could be the difference of hiring someone or laying somebody off. So this is kind of critical. These are big numbers we're talking about here, and not just for big corporations, but we're talking about the small mom and pop type shops that are out there that are, they're doing a great job, but you throw this additional tax on there, and that's going to be kind of cumbersome to them. What does this all look like? So let's talk a little bit about how this could affect the economy, because where the economy goes, so goes the market. So if we're thinking about these additional taxes, not only on the individuals, but also on the corporations, it is going to put a drag on the economy. And actually, there have been studies done on that already based on the proposals. So the question is will more taxes have a drag on the economy? And the answer, according to the Tax Foundation, is really a resounding yes. According to the Tax Foundation, the Biden tax plan would reduce the economy size by about 1.47%. So the GDP would drop that much. And that's in the long run. The bigger problem, or part of that problem, is the fact that your full-time equivalent jobs, they're estimating that there'll be 518,000 less full-time jobs moving forward. So that's unemployment. Anytime you have higher unemployment, you're going to have additional drag on the economy and certainly debt load for the country. So these are the things that we're looking at. Now, again, am I concerned as to which tax plan we're going to get? Well, I kind of like the tax plan we have right now. However, that might not be my choice moving forward, right? I might be, and as well as everybody else, under a Joe Biden tax plan. And if that is the case, we have to have a plan to try to mitigate the taxes moving forward. So should investors be concerned about higher taxes? Well, I'm going to say yes. But if you have a plan, not so much. I mean, it's not going to be as much of a problem. Now, a couple things about planning and strategies. You've all heard me talk about the 5 different strategies that we are implementing or will be implementing relative to the next downturn in the market, which we believe is still coming. But on top of that, we have to look at the tax planning and advanced strategies that we can employ if there is a change in the presidency and Biden's tax plan actually comes to fruition. Now, we have got a lot of great resources here at Daniel Krug and Associates. One of them is City National Rockdale. They do a phenomenal job of research. And they put together an election special bulletin. And if you want to copy this web address and stick it into your web browser, this PDF will come up. And the brochure right here goes through all the changes in the tax laws. We couldn't go through everything in this show, it would take way too long. But they do a great job of explaining the differences between the Biden plan and Trump plan. What they also do in that report is they give you different strategies that could be employed to help mitigate some of the taxes moving forward. So I would highly recommend that you get this election special bulletin from City National Rockdale. Again, just copy and paste this web address in and you'll be able to download it yourself. So they've got a lot of great information in there. If you see a strategy that you think really might work for you, give us a call. We'll also be looking at this as we're moving forward with each one of our clients to determine what strategy is right for you. So that being said, that's going to bring us to tell me more. Well, we're actually running out of time. So what I'm going to tell you is go to our Daniel Krug and Associates YouTube channel, and you will actually see all the past videos that we've done on webinar. And they're all broken down into 3 to 5 segments, so you can kind of take little bites of what we've talked about. In addition to that, we've got specific strategies, you know, the strategies 1 through 5 for this crisis and future crises for that matter. So you can actually go in here, take a look at this, get a cup of coffee, and just kind of relax and watch and learn. So take a look at the YouTube channel for more information. And you know what, Rocky? I think that kind of brings us to the end here now, doesn't it? So I'm going to pass it back on to you.
Wow. A lot of information, Dan. Appreciate you bringing that. I think it helped people realize there is differences coming potentially, but we can quantify them and we can create strategies to mitigate that based off your individual situation. So thanks again, Dan. Thank you to everybody that's been on watching. Again, there's no need to worry. You take care of your family and we will take care of you. So we're ready for 2020 and beyond. So you have a good day and thanks again for watching. Goodbye, everybody.
Goodbye.